Hello everyone, today is the 16th of May 2026 and this is episode number 77 of JustDario Cigar Time. Today's episode is going to be particularly important because I am going to explain to everyone what exactly is happening into the fixed income market, especially to government bond yields, and what are the consequences of the moves that, personally speaking, I was expecting. And I warned about that in my previous podcast when I said while investors in the stock market euphoria was through the roof, fixed income investors in reality were freaking out. And in the second part of the video, I am going to provide you with my perspective of what I believe is going to happen in the following week and going forward, subject to the events that might occur or not this weekend around the Middle East. Before we begin, don't forget to like the video, subscribe to the channel, and turn on the notifications if you don't want to miss any of my future updates. So let's start with interest rates, okay? So everyone on Friday was so surprised to see the sudden jump of interest rates all over the globe, from the Japanese government bond to the European market in England, and of course in the US, where remarkably the 30-year US Treasury yields closed for the week at 5.10%, and the 10-year rate closed above 4.5%. So, what are these moves signaling us? These moves are signaling us a concern in the market for geopolitical risk. There is no concern whatsoever for liquidity, let me be clear. Central banks continue to print money as if there is no tomorrow, so to speak. Even if, let's not miss this important detail, starting from the following months, the Federal Reserve announced that they are going to slow down the pace of their Treasury bills reserve operation from $40 billion a month to $10 billion a month. And you can rest assured that this change is going to impact the dynamics into the market. Why is going to impact the dynamics into the market? Because the Federal Reserve and the US Treasury have been working together effectively to enhance an official version of yield curve control. How? Because while on one side, what I just described is effectively quantitative easing, there's debt monetization that the Federal Reserve has been perpetrating since December has been used by the US Treasury to issue more short term Treasury bills and use those extra proceeds so far to buy back longer term US Treasuries, especially the 10-year US Treasuries bond. Logically speaking, and intuitively, this move allowed the US Treasuries to effectively cap the interest rates to a level that didn't concern markets that much. However, as we have seen this week, sooner or later, these shenanigans that might help to kick the can down the road in the short term might ultimately bite back and exacerbate the stress in the market when you reach an exhaustion point, after which there are no more investors like willing to buy those bonds at that yield when the background situation of markets and the economy changes. And in this case, the change in the background has been visible this week, as I said in my previous video, in the latest CPI and PPI reports that we got from the United States. So Here is something very important to understand. This market right now doesn't have a liquidity problem. The liquidity is abundant in the system. The M2 money supply on a global scale continues to increase and make new all-time high every day because, of course, without that, the whole system is going to fall apart. And as I warned before, differently from the past, today central banks, starting from the Fed, the Bank of England, even the Bank of Japan, they have plenty of facility in place to make sure that there is not a liquidity shock into the banking system, from the repo facility in the US to the short-term open market operation with the Bank of England to the you know recurrent, almost on a daily basis, liquidity support operation that the Bank of Japan runs. So from a liquidity perspective, we're fine. Okay, but the shift is palpable in the market. And while, as I said to people asking me this question, I don't think at all that rising interest rates are going to be the cause for a correction in, in the risk assets, because in order to entice investors from moving their money from risk assets that so far have been performing very well, and still stock markets around the globe are quite close to all-time high, even if in Asia on Friday we saw some pretty sharp correction in Korea, for example. On the other side, the level of interest rates that these investors require for them to be comfortable to shift their asset allocation more towards government bonds is definitely higher in this backdrop, especially when people still think that in the medium to long term, no matter what, stocks will continue to go higher. And let me be clear, they might be right about this in a sense that we know that the governments and central banks are doing all they can to assure this outcome, because in a hyper financialized financial system, especially in the West, valuation of stocks, even if they reached this completely asinine level, are so important for the stability, not only of the banking system per se, but they are very important for the stability of the insurance system, and most of all the pension system, especially in the US, when the allocation to equity in the 401k is incredibly high compared to other countries. So I believe that no matter what happens this weekend, stocks as a whole will remain resilient, especially when the most important stock in the market still, it is Nvidia, has yet to report earnings. And everyone is so buoyant ahead of the next Nvidia earnings report because, I mean, the demand for AI apparently is still going through the roof, even if, like many people, cannot explain exactly why only the US is pursuing this incredible scale up of the whole data center infrastructure ecosystem compared to Europe and Asia, in particular China. So here is the thing. Interest rates right now are signaling an increase in geopolitical instability. They are signaling an increase in inflation expectation. Even the US Treasury Secretary Bessent said, "Oh, you might expect a couple of more like hot CPI prints." I mean, what? What did you just say? I mean, I very clearly remember how a few months back when the war against Iran just started, he said, "Oh, this is just going to be a blip, a spike, and then inflation is going to come back down." Of course, like people, they can believe you at the beginning, but now they are understanding that the situation is pretty different to the one that you portrayed. And so they are reacting accordingly. There is no shortage to buy government bonds at the moment. What there might be a bit shortage about is willing people to pick up the increasing amount of debt that is required by these countries, especially by the US, to continue support their deficit. So they're demanding higher and higher yields. Okay. And here is where I want to explain what might be happening here. Not very visible in the short term, but surely is going to be very important for the medium to long term. Because while rising yield that might be a cause for slowing down the euphoria in the market to restrict financial condition and effectively cool down the overbloated valuation. In reality, what we have seen so far is that rising yield didn't stop governments from continue expanding their deficit. And with a war in the Middle East that might be resuming as soon as you know this weekend, you may rest assured that the cost of that war is going to reverberate directly across the global economy through the US government bond market, but also is going to reverberate through the economy as a result of higher and higher cost of crude oil, gasoline, and diesel. So here is the doom loop. Rising yield will be met by central banks and government with actions in order to sustain those rising yield via global financial money printing, effectively debt monetization. So, and this doom loop, it actually becomes perverse in the moment which rising yield requires more liquidity to be injected into the system from a global perspective, even if we expect the Fed to slow down, but someone else will pick up the slack, and perhaps there might be starting to be some shift from the market. Okay. But on the other side, your currency is devaluating, the purchasing power is collapsing, right? So you see interest go up and then the currencies devaluate. But the currencies, they don't devaluate all in the same way. Because if you consider the benchmark that is the US dollar, actually the US dollar has been strengthening this week. But why has been strengthening? Because other currency devaluated more. What really matters is the loss of purchasing power of the fiat currencies because more and more money is being printed out of thin air into the financial system by the global apparatus of central banks. And you might ask me now, but if this is the case, why gold was very weak on Friday and silver crashed? I mean, as we as we know, as we learned so far, and as explained in many videos, when you need prompt liquidity in order to plug stress somewhere else in your portfolio, you actually don't have that many options available besides government bonds, gold, and silver. And only later on you start trimming your riskier position. Especially when you have big position, you need to come out because selling those positions will eventually have an impact on the remaining holdings in your portfolios. And if this is happening on a coordinated scale across the globe among asset manager, you might see how this will eventually erode the run in the stock market for the longer term. But no worries, this will compensate by money printing, right? So, and here we go into the second part, and the second part here is quite important because I have the curse of being early, so I'm not worried if what I'm about to say now is not going to happen immediately on Monday or Tuesday or maybe by Friday next week. But I'm very confident that this is what's happening. So while stock overall, the stock indexes might remain resilient, I believe that considering what happened on Friday, there has been already a shift from investors from very like speculative tech stocks into stocks that might be more resilient into the future environments we are ending up into. And what is this future environment going to look like? I mean, let's be objectively honest and very straightforward, guys, here. Like the inventories, strategic and commercial, of crude oil, gasoline, diesel, jet fuel, naphtha, whatever, are decreasing at such a speed that has never been seen in history before. And even if some US official pretends that they will be able to refill the SPR in the future without any problem, the truth is that the current situation in Iran will not allow them to do so in any point in time. And as a matter of fact, US oil prices started to react on Friday, and investors already started to rotate into energy companies, especially oil companies, because here is the thing. I'm not a big fan of refineries because even if refineries so far enjoyed an incredible amount of margin because the crude oil prices have been kept suppressed, in the future this margin will rebalance. And then the whole value of this move is going to go, downstream, from upstream to downstream into the commodity producers. And the commodity producers are the energy company, especially the oil companies, with direct access to the resource. And I think some of you might be asking now, okay, hold on a second. But what happens if the United States, rather than doing as it's doing right now, like selling its reserves and oil throughout the world, decides to impose an export ban? Well, that would be a very, very dangerous move because the oil that has been extracted in the US is like crude. And the refineries in the US actually to perform and to produce high quality products, they need heavy crude. And with the heavy crude missing from the Middle East, there are not many other places where they can get it from Mexico and from the North Sea in the European market. But we already saw how many Asian countries are already buying from Mexico, for instance. So there is a competition here. So US cannot just decide, okay, we keep all the oil for ourselves, we don't give any of it to the rest of the world because that would be a complete disaster into the supply chain and create such a disruption in the market that I cannot even imagine, where it can lead. So eventually, the whole setup is going to remain open and it's going to be of great benefit for all those producers that they don't have their resources heavily located into the Middle East. In a broader sense, for the stock market, one suggestion that I give is to be careful about the stocks that have been like uh, rewarded so far by retail speculation and incredibly buoyant narrative, especially like semiconductor stock. Because, I mean, I had a conversation yesterday at dinner, and this conversation was very similar to others I had like recently. And what I've been shocked is that this person told me, "Oh, I am." Trading a lot with my PA because that is the way I'm using in order to beef up my monthly income, right? Because what he said, I'm just paraphrasing like his sentence is like, I don't have hope in my job, like the career is gonna go nowhere. I see no breakthrough and whatever. Everything is so stale. And this is something that I heard pretty often, like recently. And this very same person actually was pretty sad yesterday, and I asked why. And the reason why is because the Korean market took a pretty bad hit. And what he told me is that in a single day, he lost the equivalent of 3 months of salary. And even if his portfolio was still up, so far year to date, the guy was pretty depressed. And I believe this is the situation of many young people that only entered the market like recently and are now starting to learn the danger of chasing stock that go up so much and so fast, forgetting that you can be rug pulled in any moment when sooner or later people will start caring about fundamental valuation. And so far, fundamental valuation across the board are all coherent and all saying that the current financial markets are too overvalued. That doesn't mean they cannot remain overvalued whatsoever, but you don't want to be in a situation where you're so heavily skewed into some speculative position that a rug pull will ultimately damage your financials, your um, savings for the long term in an irreparable way. And here for today, I want to conclude. Don't forget to like the video, subscribe to my channel, and turn on the notifications not to miss my future update. Thanks a lot for the support on X, on Instagram, and JustDario.com. Keep an eye on the news during the weekend, and you know, again, I will not stop saying this. Be mentally prepared for volatility, for things to become very shaky for a while. Even if, again, I don't think that the monetary expansion is going to be ending anytime soon. So any shock from a global scale is going to be buffered, and the whole system is not set to collapse anytime soon. Have a nice weekend. Bye.